Hello and welcome to Business Incorporated. I am Bisi Adebayo. Coming up on the program today, Zimbabwe launches agricultural commodities exchange. Fitch downgrades Seychelles credit rating due to economic pressures from pandemic. Plus, IMF approves $177.96 million in emergency assistance for Benin Republic to address COVID-19 pandemic. But let's get the show started right away with intraday numbers. And in Africa, the major markets were positive at intraday except South Africa's GSC, which sustained Monday's negative trend. On the flip side, the NSE continued its bullish run with the index up 0.4%, while the EGX 30 in Egypt added 0.64%. Kenya closed negative on Monday. And it's a similar picture in the Middle East, where markets were mostly positive. Only the Qatari index was marginally lower by 0.05%. Saudi Arabia's index surged the most by 1.2% at intraday. In the UAE, Dubai's main index was up 0.8%, while Abu Dhabi's market advanced 0.72%. And in Asia, the markets declined today following investor jitters on Wall Street over a new coronavirus strain in the UK. Mainland China's stocks fell by the day, and Shanghai Composite was down 1.86% to 3,356.78, while the Shenzhen Component fell 1.787% to 13,882.3. Hong Kong's Hang Seng Index slipped 0.71% to 26,119.2. And in Japan, the Nikkei 225 shed 1.04% to 26,436.3, and the Topix Index was also down 1.56%. The Kospi of South Korea dropped 1.62%. In Australia, the S&P ASX 200 was down 1.05%. And meantime, news coming from Australia shows that the retail sales jumped 7% in November compared to October on a seasonally adjusted basis. And that's according to preliminary figures released today by the country's Bureau of Statistics. Let's take a trip to London now to see how the economy witnessed some recovery in the third quarter of the year. And Juliana Olayinka will be giving us details of this data. Good afternoon, Juliana. Data from the ONS shows that Britain's economy staged a faster recovery in the third quarter of the year than was first estimated. Can you tell us more about the latest GDP numbers?
Oh, well, there's just been a revision from the Office for National Statistics showing that instead of the 15.5% increase in the 3 months to September on GDP, it's actually 16%. That's 0.5% higher, a little bit of festive cheer amidst doom and gloom news that's coming out of Britain at the moment. As we discussed 2 weeks ago when this information first came out, this is really down to the fact that there was a boom in activity after the first lockdown, particularly in manufacturing and services. We had quite infamous Eat Out to Help Out, the government-backed scheme where Mondays to Wednesdays became the new weekends here in Britain as everybody was going out trying to get some sun, trying to spend some money and meet up with loved ones as people were able to go up and about the house. But yes, this is a revised figure, which basically means now that compared to this time last year, rather than the economy being 9.7% smaller, it's actually 8.6% smaller.
All right. Now, we're seeing reports by Bloomberg that the EU has rejected a proposal that would see the EU reduce the value of fish it catches in the UK waters by 30%. What sound bites are you getting regarding this? And are there any updates on Brexit talks?
Well, it's coming in thick and fast. It's still a developing story, but according to sources close to Downing Street, there could potentially be a deal between Britain and Brussels anytime now, hopefully before Christmas. I know Bloomberg were reporting that it was rejected. Actually, what I'm hearing is that it has actually been accepted. We are expecting the EU chief negotiator, Michel Barnier, to update EU member states anytime about now, and I believe they have accepted to reduce the quota for fisheries being one of the main contentious issues, by 25% over the next few years. We still don't know. We haven't yet heard an official statement by the British Prime Minister Boris Johnson. I believe Boris Johnson and the EU Commission President Ursula von der Leyen did speak over the phone a couple of hours ago. Of course, they're speaking about a myriad of issues, not less to do with the hauliers who are currently stuck in Kent and other issues. But Brexit obviously was the topic of most discussions. So, I've said this loads of times, so please don't quote me on it. But we do believe a deal could potentially be done over the next couple of days. And given that we have such a populist-loving Prime Minister here in Britain and all of the bad news that we've had over Christmas, this is something he certainly would like to delight the British public about by saying he managed to strike a deal in the final hour of these Brexit talks.
I'm sure many people look forward to hearing that sort of news. Oh, finally, Juliana, stocks bounced earlier today, and we saw that as the UK awaits signs of border reopening with France. So tell us, how are the markets performing at this time?
Well, there was a bloodbath yesterday, wasn't there? That triple-digit loss because of this new COVID strain that's come in from Britain. The FTSE opened up in the red at early trading. At intraday, it's slightly up, and this is because of these Brexit rumours. We don't know if there's going to be a deal or not a deal. Every media organisation seems to be reporting conflicting advice, but investors seem to be having their ear on the right tune, and the mood music is positive, which is why at intraday the all share is up 0.36%, the FTSE 100 is up by 1.60%, and the FTSE 250 is up by 1.64%. In the currencies market, the British pound is down on the US dollar by 0.45%, down on the euro by 0.27%, and down on the Japanese yen by 0.35%.
Many thanks, Juliana. Do enjoy the rest of your day. And let's turn to Europe now, where shares are attempting to recover from a brutal sell-off in the previous session as investor sentiment was shaken by a new coronavirus strain in the UK. But let's get details from Conrad Busin, who's joining us live from the Frankfurt Stock Exchange. Good afternoon, Conrad. It's good to see you. Now, the markets in Europe are recovering from Monday's losses and from the shock about the strong mutation of the coronavirus, resulting in a ban on travel and freight transportation between the UK and the European continent. But how strong is the optimism today?
Well, in terms of percentage points, there is a little bit of optimism. Our share index here in Frankfurt, the DAX, is up around about 1% at the moment. Of course, also people on the trading floors in Europe are very relieved about the news from Washington, about the fact that those two parties in the US Parliament, in Congress, Democrats and Republicans, have finally settled on a new relief bill, on a new amount of around about $900 billion to spend to help American households to get through this crisis. This is, of course, one reason for optimism. Another reason is that the recovery scenario here in Europe remains intact, despite, of course, the travel restrictions between the UK and the continent, and despite this new mutation of the coronavirus. Today here in Germany, BioNTech, which is the first company that has developed a vaccine against corona together with the American pharmaceutical company Pfizer, BioNTech said that even against the mutation, its vaccination should help. And even if that mutation makes it necessary to alter the current vaccine or to develop a new one, BioNTech would be able to do this in 6 weeks' time. So from an economic point of view, for investors, this means, yes, we can continue to hope for a recovery next year. It's not so important when exactly it will happen. What's important for investors right now is that they can really hope for it to happen eventually next year.
All right, we'll wait to see how that pans out. But meantime, Germany's public debt has reached a record high, and at the same time, the euro is trading on the highest level in more than 2 years. How much of a paradox is this? I mean, why are investors not more concerned?
Well, for two reasons, really. Number one is that at the moment, a majority of people on the markets believe that all this government debt, all the money that the German government, took on in form of new debt this year is money well spent, because the government did this. It took on this new high debt because it wants to help households, but also, of course, businesses through the corona crisis, so that eventually, as soon as the coronavirus is in check, households can spend again, people can get to work again, businesses can return to something like a normal business and prosper again. This is actually the precondition for the German state to be able to pay back its debt. We need a prospering economy in order to, the government needs a prospering economy to take in taxes and to make money itself so that it can pay back its debt. The other reason, why the euro-dollar exchange rate is at those relatively high levels has to do with the central bank's monetary policy and with a scenario at the moment that more investors believe that inflation is something to reckon with in the US rather than in the Eurozone. And inflation, this inflationary outlook, the outlook on a potential devaluation of the US dollar, that's something weighing on the dollar, and it's, helping our currency, the euro, to keep up.
All right, Konrad, one last question now. The number of IPOs has risen worldwide by 15%, according to research by EY. How much of a surprise is this when you look at the fact that markets have been shaken by the pandemic all year? Are we likely to see this trend continue?
Well, it really is or has been a surprise to many people here on the trading floors I talked to, who told me, given the shaky markets we've seen this year, remember how in the spring the German index fell 40% in only 4 weeks, just to recover 30% nearly as quickly. With shaky markets like this, it's been a surprise to see that so many companies really actually made an IPO. What's not been much of a surprise is to see so many companies trying to go public, trying to make an IPO. The valuations on the markets are high. Demand from investors, both retail and institutional, is very high. They're very interested to put their money into, those business models. And that's why, of course, there were so many companies out there trying to go public. A majority of people I talk to here are convinced that this trend will continue. The trend of digitalization continues. So there are still many companies out there who will be trying to look for investors. And also another factor, one that we often talk about, the loose money by the central banks. This is supporting the trends for IPOs. For some investors, it's just attractive to get cheap loans fueled by the central banks and spend the money on the equity markets, for example, when new companies come to the market.
All right, Konrad, thank you, and do enjoy the rest of your day. Tomorrow is another day. And yet stock futures were mixed early this morning after a volatile day on Wall Street that saw the Dow Jones erase a 400-point deficit. Futures contracts tied to the Dow were lower by 30 points. S&P 500 futures turned positive, while Nasdaq 100 futures were also in positive territory. Earlier, the Dow futures had fallen more than 100 points. The muted move in futures came as Congress on Monday night passed the coronavirus relief and government spending package. And as so-called prices now, they fell in early trade today, extending sharp losses overnight as the rapid spread of a new strain of the novel coronavirus in the UK prompted several countries to close their borders to British travellers and freight. US WTI crude futures were down 0.6% to $47.67 a barrel, while Brent crude futures fell 0.5% to $50.65 a barrel. Now, both benchmark contracts slid nearly 3% on Monday, partly erasing recent strong gains on the back of the rollout of COVID-19 vaccines seen as key to easing mobility restrictions. Meantime, gold prices fell as aid from the U.S. Congress' long-awaited passing of nearly $900 billion of COVID aid was countered by a stronger dollar, while some profit-taking also weighed on sentiment. Spot gold dropped 0.3% to $1,870.69 per ounce, while U.S. gold futures also dropped 0.3%. Gold has risen more than 23% this year, driven mainly by a raft of pandemic stimulus measures that fuel fears of inflation. Our domestic commodities market is up next, right when we return. Please stay with us. Welcome back. Now we're turning our attention to transportation today on our domestic commodities market segment. Now there's a strong correlation between inflation and the cost of transportation. We know that transportation accounts for approximately 7.5% of the Nigerian inflation basket. Meanwhile, PMS pump price has oscillated between 161 naira 17 kobo and 167 naira 27 kobo in November. But joining me now to talk more about how all of these will impact transport fare is Fisayomi Folashade, who's a senior analyst at the Financial Derivatives Company. Good afternoon, and thank you for joining us on the program today. Now, when you look at the data from the NBS now, good to have you. Now, in November, the average fare for intercity and intracity travel increased by 36.38% and 73.84% respectively, relative to what we saw in November 2019. But then, Christmas is coming up this week. There will be a surge in intercity travel. So you think that the transport fares will increase, and by how much?
Yes, so there's a correlation between inflation and transport fares. A rise in inflation would definitely lead to a rise in transport fares. But usually there's always a high cost of transportation during the festive period. And this is due to high travel demand during the period. This is a period whereby friends and families and a lot of people get to meet with their people, their friends and families. And so the drivers, transporters take advantage of the high travel demand and also increase their transport fares. But we must also consider that this is a COVID-19 year where consumer spending has been negatively affected by the pandemic. And so the rise we will see in transport fare this year would not be as high as what we've seen in previous years. So take, for instance, maybe the Lagos to Ibadan ride last year was about 5,000 for a bus ride. So this year we should see a reduction to about 4,000 naira. But also we should consider that if bus drivers are going to go by the COVID-19 guidelines and reduce their capacity to about 50%, we should know that the passengers will bear the cost and pay for the remaining 50% capacity.
Now, you talked about Lagos to Ibadan now, and that brings me to my next question, talking about the railway system, which, of course, in recent times, we've seen renewed investment by the government, rehabilitating the rail lines and, of course, building new ones. Now, do you think that the new railway service will have an effect on the cost of transportation?
So the railway operation in Nigeria prior to this time has been inconsistent. The commencement of railway operation is a good development as it will provide commuters with another travel option, right? So yes, there's going to be impact on road transport fares. The railway transportation is a very efficient means of transportation in terms of inconvenience, insecurity, terrorism, kidnapping faced by transporters on the road. So railway transportation as well will be able to accommodate as many as possible and thereby reducing the demand for bus transportation. It's going to be a gradual process. So the gradual process is a shift from bus transportation to the railway transportation.
All right, now let's talk about domestic airlines now, which have increased their fares by over 100% at a time of the COVID-19 protocol. But what are the factors driving the spike in airline tickets? And is this price likely to increase further during the Yuletide and beyond?
So it is no news that the airline industry is one of the most affected by the COVID-19 induced pandemic. So for now, the airlines are trying to recoup the losses made during that period. And following the COVID-19 guidelines as well, the airlines have to carry about 50% of their capacity. So the passengers will be able to pay for that cost. And remember that the Yuletide period is also at the Harmattan period. So there will be decline in the demand for air travel due to cancellations and all that. So there's going to be a decline in that aspect. But we hope to see vaccines coming into Nigeria very soon. And so this will make airlines also go back to their full capacity, thereby leading to reduction in air tickets.
I'd like to thank you, Senior Analyst at the FGC, Fisayomi Folashade. Thank you for sharing some of your time with us this afternoon. To all the stories now, the government of Zimbabwe has launched the Agricultural Commodities Exchange that will ensure that market forces determine the prices of farm produce and close the existing arbitrage gaps caused by middlemen. According to the Finance and Economic Development Minister, Mthuli Ncube, the Commodities Exchange will provide an organized market of players across the agricultural commodities value chain, which includes small-scale to large-scale farmers, buyers, regulators, retailers, banking institutions, and warehouse operators. This will close the existing arbitrage gaps caused by middlemen and stimulate price discovery. In 2001, the Zimbabwean government closed the commodity exchange and gave the monopoly to buy and sell maize and wheat to state grain producer, the Grain Marketing Board. The latest development means that the government will no longer fix the prices of agricultural commodities. Fitch Ratings has downgraded Seychelles' credit rating due to an increase in the country's external debt. The island nation's credit rating has been downgraded from B+ to a B with a stable outlook this year. The Fitch B ratings indicate that while financial commitments are currently being met, the capacity for continued payment is vulnerable to deterioration in the business and economic environment. The Minister of Finance, Economic Planning and Trade, Nadir Hassan, says this rating downgrade is due to the fact that the country's economic performance has worsened amid the COVID-19 pandemic. According to Fitch Ratings, the key drivers for the rating is due to a very slow recovery in tourism, an extension of fiscal measures, and greater exchange rate depreciation. And the International Monetary Fund has approved $177.9 million in emergency assistance to Benin Republic under the Rapid Financing Instrument and the Rapid Credit Facility. This disbursement supplements the augmentation of $103.3 million approved under the ECF in May 2020. The IMF says in the statements that weaker external demand and the deepening of the economic impact of the COVID-19 pandemic have worsened the country's external and fiscal positions, and additional resources under the RCF RFI will help scale up the government's COVID-19 response and catalyze additional donor resources. Economic growth is projected to decelerate to 2% in 2020 from nearly 7% in 2019 as a result of containment and mitigation measures, the global economic slowdown, and the prolonged border closure with Nigeria. And that's our program today. Thank you for watching. I'm Bisi Adebayo.